So today I'll talk about whole life insurance. I'll go over what it is, how it works, and at the end of this video, I'll go over exactly what to do if you're interested in getting a whole life insurance policy and you want to maximize the benefits, especially the cash value benefit. So with a whole life insurance policy, let me start with this question. How long do you think you have to pay premiums with a whole life insurance policy? Do you think that you have to pay premiums for your whole life? A lot of people do. You do not. A whole life insurance policy is a policy that lasts for your whole life unless you cancel it or if it lapses. So we have three main pieces to a whole life insurance policy. First, we have the actual life insurance, which is called the death benefit. It is called a death benefit because this is an insurance policy, and the benefit is a monetary benefit that is paid out to your beneficiaries when you die. Now, what you'll typically see with a whole life insurance policy is as time passes, your death benefit will gradually increase. And an important note about the death benefit is when you die, it is paid 100% income tax-free to your beneficiaries. Notice that I said income tax-free, not estate tax-free, as death benefit proceeds are not exempt from estate taxes. But we've got the actual life insurance benefit. Then we've got how you can pay money into the policy. There's two ways you can get money into a life insurance policy. First, we have this term, which is called your base premium. If you've had any type of insurance, you've heard the word premium. But first, you've got your premium. And then next, we have what is called your paid up additions rider. Short version of this is a PUA rider. Now, starting with the premium, because this is going to be attached to every whole life insurance policy, the PUA rider is optional. The premium is level for the life of the policy. What I mean when I say that is we will not see it fluctuate as time passes. When you start a whole life insurance policy, whatever that premium is locked in for the life of the contract. It will not increase as the years pass. Now, how long do you have to pay that premium? Do you have to pay for your whole life because this is called a whole life insurance policy? You don't. You might see a policy that says premiums are payable until you are 100 years old, which sounds like forever because it is. It's for most of our lives. However, it's very easy to take that type of policy or any type of policy where we stop making payments altogether after 2 years. Maybe it's 5 years. Maybe it's 10 years where we say, I want to pay until I retire. Or maybe you do say, hey, I want to pay into this policy forever until the day I die because I just want to keep on stuffing money into it so the cash value keeps growing and I can leave even a larger death benefit to my beneficiaries. It's completely up to you. And you don't even need to decide this when you start a policy. You can adjust as you go. Next, we have what is called your PUA rider. So this is optional. You can elect to add money some years, skip some years. The amount can fluctuate. Depending on the company, you might be able to log on to your online portal and just throw money into this PUA rider. I like to call it a cash dump-in. You'll see exactly why. But before we hit on that, let's hit on the third item with a whole life insurance policy. This is what everyone is interested in, the cash value. So what you'll see with a whole life insurance policy is that the cash value will gradually increase over time. And when you hit 100 years old, with some policies, it's at the age of 121 years old, the cash value and death benefit will be equal. The death benefit will always be higher prior to age 100, and the two grow together. So sometimes we hear, if I die with a whole life insurance policy, the insurance company keeps my cash value. The death benefit accounts for the cash value. Day one, you might start out with a $1 million death benefit, and if your cash value has grown to $500,000, you see your death benefit is worth 1.8, or an amount much larger than the original $1 million. So the death benefit does account for the cash value growth. So let's hit on some bullet points with the cash value. So the cash value, because this is what everyone is attracted to, firstly, has no risk. And what that means is that your money is not invested in the stock market. What you'll see is that most life insurance contracts, or I should say all life insurance contracts, will have a guaranteed rate, whole life insurance contracts that is, they'll have a guaranteed rate that will range somewhere between 2 and 3.75%. Now, if you already have a whole life insurance policy and you started it before 2022, it might have a guaranteed rate of 4%. If it started after 2022, the guaranteed rate will be somewhere between 2 and 3.75%. Now, on top of that, you'll see most insurance companies will pay what's called a surplus. They declare this every year. And the guarantee plus the surplus gives us what is called a total dividend rate. And the dividend rate with the top life insurance companies ranges between 5 and 6%. And if you're wondering what the top life insurance companies are or who they are, I'll tell you right now. These companies specifically focus on whole life insurance and have the best track record when it comes to cash value growth and death benefit growth over time. And I say that based on actual policies we've seen live the test of time. So your four major mutual companies are MassMutual, Guardian, New York Life, and then Northwestern Mutual. If you'd like to see what their 2024 dividend interest rates are, I'll tell you right now. MassMutual is 6.1%. Guardian is 5.9%. New York Life is 6% flat. And then Northwestern Mutual is 5.15%. I have seen these four companies always go back and forth with each other. What I would not recommend doing is picking a company that has the highest dividend rate today. And I say that because I've seen all four of them go back and forth with each other over the years. They all say, we're the best and we have proof of it. When I look at independent studies or we look at policies that we've examined over time, we've seen all four of those companies go back and forth with each other. In my opinion, we can't go wrong with any of them. Now, one thing I want to mention about the dividend rate, because this is really, really important, that this is a gross rate, which I don't like the terminology in the industry because it confuses people. But if you said, what's my bottom line? What am I actually going to get in terms of net growth on a life insurance policy? If I have a dividend rate between 5 and 6%, the net rate of return or internal rate of return is probably going to fall somewhere between 4 to 5%. If we want to shoot it more conservative, we can say somewhere between 3 to 5%. A couple more bullet points here. We have a unique loan feature, and how this works is you can access the cash value anytime, and when you access it, you continue to earn interest on your entire cash value. So, for example, let's put this over here in purple. Loan feature. If you have cash value of $100,000 and it is earning 5%, and you elect to take a loan for $50,000, let's say that costs you 5%, you will have paid $2,500 on the outstanding loan. However, the insurance company will still pay you, here you go, 5% on the full $100,000. So your money keeps on earning interest for you. And in cases like that, we like to model exactly what the loan looks like. If I borrow, pay it back, don't pay it back, so we can see everything up front. But that's the loan feature. And then lastly, if we do everything right, we can access the cash value 100% tax-free. Now, I say if we do everything right, what that means specifically is the agent needs to follow IRS rules, which is very simple. The term we want to avoid here is called a MEC, which stands for Modified Endowment Contract. There are other ways we can trigger a taxable event as well. If you have questions about that, feel free to drop a comment below and I can include a video in the comment section. You can also just search Whole Life Taxes on our YouTube channel. So that's an overview of how whole life insurance works. Let me wrap this up by talking about how to get it right, especially if you're interested in the cash value. So with a life insurance policy, a lot of people aren't aware of this, is we can actually set it up however we want. Let's call this the policy setup. So the first thing you can do is just buy a life insurance policy. And if you do that, it's not very attractive. It looks like the example we mentioned earlier, where it's going to take 10 years just to get your money back, where the cash value finally surpasses the premium. People typically don't like that. But what you can do is this. Let's say you want to pay $10,000 into a life insurance policy. And it can be 1,000, it can be 100,000, you can just take off a zero or add a zero. You can choose where your money goes. It can go toward that base premium, or it can go toward that PUA rider. Want to see how it works? When we do this, money you pay toward the premium does not show up in cash value in the first year. Eventually, as you keep paying that premium every year, the cash value begins to build up. But in the first year, I've got zero. In many cases, in the second year, I've got zero. Then finally, I see it come back to work. And the reason why is because it buys me life insurance first, the actual death benefit. This is why if you just shop for a life insurance policy, you pay a premium, you get life insurance first, and then eventually you see cash value. Whereas this paid up additions rider gives you cash value immediately. It gives you some death benefit. If you put $1 into the PUA rider, you might see another $3 show up in life insurance. But why people put money here is really to maximize the cash value, because they're interested in the fact that there's no risk, I've got that unique loan feature, and I can access it tax-free. That's the appeal right there. The death benefit is appealing to a lot of people too. So when we set up a policy, going back to the 10K example, I would ask, if I'm you, how do I minimize the premium as much as I possibly can? And the answer is, with those 4 companies we mentioned earlier, usually we can drive the premium as low as 10%, because the premium does not show up in cash value in the first year. It takes a while to capitalize, so I'm going to minimize that piece and then plow the other 90% into the PUA rider. And my favorite part about this is exactly what I would do, by the way, when you request an illustration from any agent that you're working with, at least to see it. When you do this, 1, it gives you the most cash value, but 2, it makes it extremely flexible, because this piece is optional, meaning you don't have to add it. You can do it at your discretion with some companies. So what a lot of people like to do is set it up where they commit just to the minimum premium and then add more money whenever they want. So here, of 10,000, the minimum would be 1,000 per year. If someone's paying in 100 grand per year, their minimum would be 10,000 per year, and they can add the additional money at their discretion. And then remember this example where it's taking about 10 years to get your money back here? I'll wrap up with this. When you set up a policy truly for high cash value, like the chart below, you start out with a lot more cash value, and you typically get your money back somewhere between 3 to 5 years instead of 10 years, and you've got a lot more money long term too. So that is a quick overview. We'll call this Whole Life Insurance 101. I do hope you enjoyed it. Let us know your thoughts, and thanks so much for watching. I appreciate it.